Good evening, everybody, and welcome. Yes, my name is Ross Trotter. I'm the fund manager for Foresight Solar Fund. First of all, I'll just take you through this. We're a FTSE 250 listed investment trust. We celebrated our 10-year anniversary last year in Q3. We've been around, therefore, for quite a while, delivering what we do on the tin. We're invested in utility ground-mounted solar and battery storage. So we're very much at the large generation end, more than what you heard from Nigel earlier at the start in terms of more home-based generation. We are part a little bit more, I want to take you through why this is part of the energy transition, and we see that as the biggest investment opportunity of this generation at the moment. So a little bit, first of all, myself and my colleague here with me today, we both work for Foresight Group. We're an international investment manager, sustainably focused on sustainable infrastructure, and we have offices around the world and currently manage about 12.5 billion of AUM across a number of different investment vehicles. We have offices in 7 different countries, across here in Europe, in Madrid, in Rome, and also in Australia, where we bought another investment manager a couple of years ago. I'll take you through particularly what it is we're here to speak to you about today, which is the Foresight Solar Fund. So we've been here for 10 years. We were one of the first in the sector coming in terms of investment trusts investing in the renewable energy sector back 10 years ago, when we built up one of the largest portfolios in the UK of solar projects. And these are the large-scale ones that you'll probably see if you're driving along the motorways or driving along the A roads around the country, predominantly in the UK, based in the sort of, you can see the Midlands and the South, where the solar radiation is a bit higher than in the north of the country. We've got 50 projects that we built up between about 2013 and 2017, all of large scale. And the reason we started here, they are all backed by government-level subsidies. So the ROC subsidy programme that actually expired several years ago, back in 2016 now, but continues on for another 12 years in terms of the assets that we have. Subsequent to that, we're a diversified fund. There are others that are just focused on the UK, but we've subsequently gone to projects in Australia. Again, we're looking to invest in projects that were set up and backed by government subsidies there. So we have 4 projects totaling 170 megawatts in Australia. More recently, in around 2019, we also went into Spain. Spain is a market that doesn't rely on subsidies these days, but there is a very deep liquid market for us to sell the energy that we generate from these projects out to corporates, and we sign sort of 10-year what are called power purchase agreements with off-takers. So we sell our energy from our projects in Spain through to the likes of Shell and Statkraft, who are one of the biggest energy producers and buyers in Europe. Also going on to, so a couple of years ago, we changed the mandate to allow us to invest a modest allowance in battery storage that will help balance the grid. We see that as being a complementary revenue stream from those projects coming through to balance off the revenue stack that we get through from solar. What I want to talk to you about, these types of trusts, and we've heard about real estate earlier in the evening as well. These kind of trusts have typically been focused on paying out a strong dividend. We started off paying a 6 pence in the pound dividend. We're up to 8 pence an 8 pence dividend at the moment. Similar to investors in the real estate space as well, we are currently trading at quite a significant discount to the NAV. We're currently about 30% down on what we currently see the NAV as, and that is offering a circa 9% yield on the dividend at the moment. What we want to take you through a little bit is where we see the fund going from here, because we think it's important to switch more to an element of offering a very strong dividend yield and yield for the fund, but alongside capital growth to come through as well, and more of a total returns play. But to look at this and talk a little bit about simply how do we generate income for the fund? Well, we have our solar farms that are dotted around various different locations. You're taking the irradiation from the sun, those solar panels converting it into energy. There we sell that energy About half of what we get is through energy sales that we sell off to off-takers, the likes of those big energy companies, the rest coming through from the subsidies here in the UK and other jurisdictions as well. So that's the governance element of that. Distributions come up through the listed solar fund and are paid out to shareholders. The sustainability element of it, this is a very important. The majority of our shareholders are large institutional companies, and the sustainability angle is becoming increasingly important for them. We benefit from having a very low carbon footprint ourselves. We do have to buy some energy. We buy it from the likes of Good Energy we heard about earlier. But we also have a number of criteria that we hit in terms of renewable energy generation. To give it an idea of the scale, the level of energy that we generate would power over 400,000 homes for a year in the UK. So moving forward, this is a few stats here from our year-end report that we published just a few weeks ago now. As we've heard from other sectors as well, there's a lot of focus at the moment around the capital allocation of funds and what are they actually doing and delivering on. We've had a very disciplined capital allocation policy agreed between ourselves and our board. We've actually been investing a lot in buying back shares at the moment because we see them as being significantly undervalued. We've also started divesting and selling of some of our assets to recycle and prove the valuations. We recently sold down 50% of a portfolio there in Spain at a 21% premium to NAV. We've been also looking to pay down the debt from the company as well. Like others, most of our long-term debt is all totally amortizing and hedged out at fixed and low income rates that we secured a few years ago. But we do have a variable rate on our RCF facility that we're looking to pay down. We're currently about 75 million drawn of 150 on that, but we've paid off 40 million during the year. And then what we'll get onto a little bit to speak to about is where we see the growth coming from in this vehicle into the future, which is moving a bit earlier in the development cycle, going into development stage projects, bringing these through construction and into operations, and a bit more of a trading model for the fund here. I think just a couple of things we'll point out in terms of the stats from the year ago. Sort of since the company listed at IPO over 10 years ago now, it's 120% return in the NAV, total NAV return, and a total shareholder return of 84% there that we think compare pretty favourably to the peer group. We have a progressive dividend policy, which means from our side it will increase every year. This year we increased the dividend target for 2024 by 6%, so it was above inflation increase for this year. A little bit here on the generation, so 85% really of the portfolio by generating capacity is in the UK. You can see that we've got a pretty solid base load of when we built up the portfolio there up to about 2018. That stayed pretty solid. The major fluctuations really from the portfolio here in the UK is how sunny it is. And really we've got a good feel of that now in terms of the level of generation that happens and occurs after 10 years of operating history. And it is the fact, even on days like today, these panels will be generating electricity. It's only really, obviously not at night, or in those times when we're having really stormy weather. But that's and the peaks and troughs of that are really coming off those better years that we've had when generation and irradiance have been higher than normal and budget. What you can see there's the Australian portfolio in the gold as well, and we've recently added and started bringing Spain through for its first full year last year. So it's a continual growth pattern of bringing through generating assets in different jurisdictions across here. Key element of this is how do we get our revenue and how do we get it in? So as I said before, these at a very simplistic level, these blocks show the build-up of that. The light blue block at the bottom, and this is forecasting for the next few years, is the level of subsidies, government-backed subsidies that we receive. That has historically been about 50% of the income for the fund. It dropped in more recent years because the price of electricity went up itself. Then the remaining 50% is energy that we trade in the market and sell off to counterparties. What we do, similar to what Nigel was saying earlier, we actually look to forward sell a lot of this energy to sort of balance out the peaks and the troughs of the energy prices. So the dark blue block on here is the level of contracted energy that we've got and we've fixed at certain prices for this year, next, and we build that position into years ahead. We can typically fix energy prices on that element that we're selling for anywhere between about 1 and 5 years ahead, and we look to build out that position to offer dividend cover. So you see we've actually had, in the year just gone, our dividend cover has been about 1.6 times. We're forecasting about 1.5 times for this year, 1.3 thereafter. Power prices are coming down, but to a sort of normalised average that hasn't really changed much sort of since pre-pandemic, and we're very comfortable with being able to offer in excess of 1 times dividend cover for the foreseeable future. I've just skipped through this at a time, but really this is a part of what we've been talking about, our capital allocation policy as well, where we've had one of the most, for our own subsector, that I say renewable energy, by the size of the fund, that's about circa 500 million. I think the market caps of all of them have dropped significantly recently. So going back to another presenter, I think it's a very good time to be looking at these investment trusts. But our share buyback is one of the biggest in our subsector by the size of the fund, and we've committed 40 million to buying back shares there. We're committed also to selling around 200 megawatts of our portfolio to recycle, looking to sell that at a profit and recycle it back into paying down debt at the moment, but also into other value-add opportunities going forward. We've got the debt repayment where we're paying that down, and also what we see is quite a significant dividend increase. And those numbers there quoted are just at the year end. In fact, the share price, most of the market has slid off a bit further since then. So actually, if we were trading on NAV, we're giving about a 7% yield on that. We're currently giving on today's share price about a 9% yield on the current share price. And going through, this is a quick slide here to sort of talk through how we're using that cash that we're coming in. So actually, the portfolio itself generated around 120 million of revenues and cash from there. Once we've paid out the dividends, we've been focused on paying down debt and the share buybacks. It's this side of the portfolio. Our current portfolio is just over 1,000 megawatts, a gigawatt of generating capacity at the moment. We are one of the largest listed solar funds on the FTSE 250. But where we see the opportunity coming here is through the development stage pipeline and the construction pipeline, and how we're taking that forward. And we'll just talk to a bit of an example of what we've actually done recently with the first investment we made. So we bought a portfolio of 3 projects in Spain back in 2020. Our dedicated team in Madrid, signed the contracts for these, so actually signed the contracts to build the projects, locked in 10-year PPAs. These were with Statkraft for there, and allowed us to add in a modest level of gearing up here to give us the kind of returns that we're looking for, which is sort of in excess of 8 to 9% return. We then, as we brought those projects out of construction, were able to show an uplift to the NAV of just under 2 pence as we de-risked those projects and brought them through. And then we actually sold down 50% of those projects to a third-party investor looking to invest in more de-risked operational assets last year at a 21% premium to the NAV. So a lot of us in this sector are doing this to look to prove the valuation of the assets that we manage. I'm not just talking about this for the sort of current macroeconomic cycle, but what we're looking at and what myself and my colleagues are looking to do is to move more to a trading strategy for the fund. It's typically been a yield play and looking to offer that sort of very solid yield. Obviously, as gilt rates have risen and we've got into a higher, an environment of higher gilts and higher fixed income, what we see now is the development portfolio that we've got. We've got about 500 megawatts across 7 sites in Spain at the moment. What we're looking to do is to build that up to about a pipeline of about 2 to 3 gigawatts across different jurisdictions here in the UK, our home market, also Spain, other European jurisdictions as well, and build this into more of a trading strategy. So actually, when you bring the projects through development and get them to the ready-to-build stage, we could then flip the assets on. We know that the value of these projects that we bought in Spain will already be worth several times what we've paid for them and agreed to pay to the developer. Or we could build them out, take them through construction, bring them into operations. They would then be contributing to the yield of the fund, or we could sell down and realise them then. So the message I want to leave you with from this is a bit of a change in the strategy of the fund to going to more of a trading strategy, adding more opportunity for growth from the fund to accompany the strong yield that we do at the moment. So I'm conscious of time, probably just leave it there for the moment and see if we're open to any questions.
Okay, now, Ali didn't get a chance earlier on. A question down the front here, please, Steve. Thank you.
Hello. I know Foresight mainly for their VCTs. So what is the rationale to run this as an investment trust? And I think Foresight does have perhaps a VCT which is based on renewables of some sort. I mean, so I'm asking about the rationale. I mean, a VCT probably gives you much better return, tax relief, and the formula as an investment trust is, when you are introduced to it for the first time, it's very difficult to really get a real picture of what is it for me to invest in this animal.
Yeah, I think it's a very fair question, and Foresight, as myself and my colleague know, actually started off in, the background was venture capital trusts and a lot of this, and we still have a number of those. And there actually was a solar trust, VCT, that was recently exited at quite a big premium for the investors in that. So I think the point of this and raising this vehicle originally around 10 years ago was to target large institutional money coming into to pay for it. These are large sites, these are large amounts of money. We've been raising probably around 40 to 50 million pounds a year when times were better. So it was particularly suited at that market. I think, like you've heard from another presenter this evening, we do think that there is a good opportunity for this in retail investors at the moment, particularly where the share price and the yield is coming from this. I think it would be fair to say you have to do your own research into what vehicles work best for you, but the point at where the share price is at this on a 30% discount at the moment, the level of yield it's bringing off and the potential for growth from there, we feel could be attractive versus other products in the market anyway.
Thank you. Question here, please. Thank you. Then we'll come to you.
Could you expand a little bit on the PPAs you have? Specifically, are they indexed to inflation? And if so, what percentage of the PPAs are indexed to inflation? And my second question is, it seems to me your business model is quite close to another trust, which is Next Energy Solar Fund. To what extent is yours different to their model? Thank you.
Absolutely, good questions. I'll tackle the first one. So our PPA, it differs. None of the PPAs, which is selling the energy, have fixed. You don't typically have indexation aligned to them. You can do on some of them, but actually it's the subsidy element that is predominantly indexed on that. The fixed price PPAs we have in the Spanish market, for example, at the moment, there is a bit of a trade-off there. You could get them with indexation, but you'll start off with a lower cost up front. What we've done is fix them at prices that we see as attractive for the longer term and for the 10 years of which they're in operation, really. So I think without getting into too much detail, it differs between markets. What we'll do to look is what we think is an attractive price, either with an indexation or without, over a sort of the period in which we sign those PPAs. The ones we have for the majority of the operational part of the UK portfolio, we're fixing those on a more regular basis, so we're not locked into a single price for a long time. And then, it's a very good question, because I'm sure there's a number of people out there that do know there are other solar funds in the UK market. We're one of 3 that all linked at the same time, and you mentioned one of the other competitors. I think the point of which, and this has been a lot of discussion with our board of directors as well over the last couple of years, is how do we create something that's differentiated here? And it goes very much to this point of what I'm talking about. I think I won't speak for the others, but we are diversified in terms of jurisdictions and in terms of technologies that we're looking at. And it's really moving to what we see as more of this trading model that we see can help offer not only a high quality yield coming out of this, but also growth for going forwards as well. And we see this sort of hopper here on the left-hand side. If we start to add that in with more and more development pipelines that we have with partners, that as the wider Foresight group, that we are very well positioned to source. We have offices across the globe, and I think it's the strength of the investment manager as well and the teams that we bring behind that. to bring those projects through and start to trade. We've given an example there of the kind of uplifts that we can show from that. Ideally, we'd like to have a portfolio of between 2 to 3 gigawatts, so about 5 to 6 times what we've got at the moment. And then on a regular basis, every year we'll be seeing more projects coming off. We may end up selling as many of those projects out to third parties for them to continue to build the renewable generation we need and help use some of that to fund back into become a bit of a self-funding model, to be honest. So that's what we'd say is the differentiator at the moment.
Question here, please. Yep.
Oh, you mentioned something about battery storage you were getting into. I wonder if you could expand on the fun and games that they've been having with National Grid.
Yeah, I think if you look, and for people who want to know a little bit more, there are the dedicated listed battery funds, and I know a number of them, their fund managers have been talking about the challenges here, so there's a lot more detail I'm going to probably cover in a minute or so. But it's fair to say we are investing in predominantly standalone battery storage. It's only 10% of the fund at the moment. We've got our first project in that in the UK, which is next door to one of our solar parks coming through, should be finished operational by summer this year. It's absolutely right, and that has experienced some delays in construction. It's about a year and a bit delayed because of the grid infrastructure works that are needing to be built out at the moment. And the simple fact is it goes to the same, I think, skill shortage that they've had installing heat pumps and things like that. Did hear a quote the other day that the average age of most of the people who work for the decentralised grid operators is in their mid-50s at the moment and will probably be retiring before long. So actually having that expertise to build out what is a decentralised grid, ourselves and others will be building these battery projects all around the country. So I think there is a challenge, there is a bottleneck there. There's also a challenge on the revenue side that the grid, even once they're built, they're not all being utilised at the moment. But I think what we'd see is there are some teething problems in that market at the moment. But the UK doesn't have a huge amount of hydroelectric power. We don't have a large amount of other interconnectors with other countries. So actually we are going to need to rely on the likes of batteries to balance the grid going forward. So you're absolutely right, there's a challenge there. We're taking a sort of medium to longer term view of this, that it needs to be sorted out.
Question here, please. Thank you.
Why do you not have more assets in abroad in Australia and Spain than in England?
It's part of the fund mandate at the moment. So our fund we have a 25% allocation to overseas investments as things stand at the moment, predominantly coming out of originally, like a lot of the funds in the space, the UK has been the home market. So I think in a number of ways, what the UK has done and delivered was sort of from the early 2010s, it's had the right government regulation in place with the subsidy regimes to kickstart the investment in renewables. So actually, we see it, and we don't need subsidies to operate in the UK at the moment. We think it's absolutely fine to do it we could do the same model that we do in Spain. We then started to move into other markets that we saw as attractive for solar and have good, solid legal structures, similarities to the UK as an investment market in general. Therefore, Australia, Spain will be very reliant on solar and wind for the generation for that market as well. I think what we'll do is we would like to seek to grow both in the UK and overseas, but do it by growing the fund as a whole. I think we'll keep that allocation of 25% to overseas at the moment. We have made some divestments. We'll be recycling capital. I think we'll look at that and review it as we go forward. But we want to, I think just to sort of wrap that up, we're looking to operate in sort of well-defined solid markets that we know. We're not going into emerging markets because of the risk profile of the fund at the moment.
And a second question, if I may. What's the age of the infrastructure with regard to replacement and obsolescence?
Good question. As a 10-year fund, and we bought some of these projects right at the start, they're coming up to their 10-year anniversary, many of them. One of the key questions and points around this is when talking about infrastructure has very long lives. It needs replacements during it. We're starting to get into that cycle where some of the big pieces of kit, so the electrical inverters, what connects our energy generation to the grid, need replacing. We have our own in-house asset management team that look after that and do it. It's a ongoing process, and you need to make sure that you're constantly evaluating what those life cycle needs are. It's the same as any, I'm an infrastructure professional, done this for about 20 years. It's the same in any asset class that you do. You need the people and the engineers to be looking at to make sure that you've got that well. I would say that I think the way our team handle it is borne out by the generation numbers and how we compare to the peer group in terms of that.
And that's been incorporated in your numbers.
It's all incorporated in our numbers, and we update on a regular basis as well.
Thank you.
Thank you very much indeed, Ross. We are then now out of time. Really appreciate that. Thank you very much.